Hi viewers, greetings to all. Today we are going to learn the concept of national income and its relevance to UPSC exam. We all know the World Bank has divided all the countries around the globe into three categories, right? They are lower income countries, middle income countries and developed countries. Have you ever thought on what basis the World Bank has divided all the countries into these three categories? Right? It's based on per capita national income. What is per capita national income? A country's total national income by divided by its total population. Bit tricky, right? Let's come and understand the concept of national income. If you want to understand the concept of national income, we must aware of these three concepts, right? It's GDP, gross domestic product, and depreciation, and GNP, gross national product. Let's discuss each topic in detail. What is GDP? Try to decode the acronym. The GDP means gross domestic product. Gross means total, domestic means in a country's territory, and product means the value of production of goods and services. If we sum up this definition, we'll get GDP, the total value of goods and services produced in a country's domestic territory in a year. This is called GDP. Have you ever wondered if you want to produce any good or service, we need these four factors. What are they? Entrepreneur, capital, land, and labor. Have you ever thought about it? Who is the entrepreneur? Let's discuss in detail. Who is the entrepreneur? Entrepreneur is the person who is willing to take risk to make the profit. Okay, to start any business, the second factor we need is capital. Without capital, we cannot start any business. And the third factor is land and building. And the fourth factor is labor and employees. These are called the four factors. Without these four factors, we cannot produce any goods or service in an economy. Right? Let's take the classic example of study hall. Study hall, they are providing a service for you, right? To to operate a study hall, to start a study hall, we need an entrepreneur, right? We call him as owner, and he needs capital, and he needs land and building, and the final one is labor. Here labor means the sanitary workers and the manual cleaners and the receptionist consultants people. These four factors. Let's take another example. Suppose a bookshop. A bookshop also needs an entrepreneur, a building, and capital, and workers are labor. So you got the idea of how these four factors used to produce any goods and service in an economy, right? So after knowing this GDP and these four factors, we must know how can we calculate GDP, right? We cannot go to each and every single shop and we cannot go and ask them how much value of goods and service they had produced in a year, right? That's why our government of India adopted three methods. One method is income method, second method is expenditure method, and third method is valuation method. Let's discuss in detail. If I had pen and board and something to write on, I could have delivered in a better way, but I will try my best to understand this concept. First one is the income method. By providing these four factors, I already discussed you, to produce any goods and service, we need these four factors. They are not for free, they are at cost, right? Nothing in an economy will come with free of cost. They are not free. For entrepreneur, he works for profit. For capital, the borrowed capital, he need to pay the interest. And for the land, he need to pay the rent. And for labors, he need to pay the salaries or wages. These four factors will come at a cost. We call this cost as factor cost. Okay. In expenditure method, in income method, in gross value addition method, we calculate the cost of these materials. First, the income method. The entrepreneur, the wages, if you sum up the profit, wages, rent, and capital, interest on capital, we'll get the interest method. And once we get the income within our hands, because we are providing the service to the companies, once we get the income on our hands, we spend the income. So this is called expenditure method. By calculating the expenditure we are spending on other goods and services, by calculating this, we can get the value of GDP. Okay, don't get confused. It's a simple concept. It is a very easy concept to explain on board with a chalk or pen. So try to understand. In expenditure method, we calculate the consumption of consumer, and the consumption of government, and the consumption of private firms, and the exports and the imports. This is the simple formula for to calculate the value of goods and services produced in a country in expenditure method. And the third method is value addition method. It is very important. It simply means we are adding particular value at particular stage of point to produce the final goods and service. Take the example of a coffee. When you go to coffee shop, they will charge you 150 rupees to 160 rupees in a coffee there, right? So first they will buy the milk and the raw materials. These are from agriculture sector, and then they use one coffee machine. These are from manufacturing sector, and then one guy will serve you the coffee, right? So the cumulative amount will get to 160 rupees. The initial price of milk and coffees are it will cost around 30 rupees, and after the coffee making mission it will add another 40 rupees, and that service another 40 rupees and 100, and the profit he is making is another 50 rupees. So here we are calculating the value addition at every stage of the final good. Why it is so important? We all know India is a major exporter of pharmaceuticals, right? But we are also the major importer of active pharma ingredients from China. We are importing the ingredients from China, and we are producing the final goods, in this case medicines, and we are exporting to other countries. Suppose take the example of Dolo 650. Do you know the price of the Dolo 650? 20 tablets are there. Its costs around you 30 rupees. Can we say the goods and the good produced in India 30 rupees? No, we cannot say, because we imported the inputs from China. Let's assume the cost of the inputs are 10 rupees, and we made the final product price 30 rupees. We need to deduct this 10 rupees from the final price 30 rupees. So the value we produced within India is just 20 rupees. And what is the importance of gross value addition method? Value addition method. See, this method will give you a clear picture. Which sector is underperforming, which sector is outperforming. With this idea, we can allocate our budget and we can make our policies in a very efficient way. That is why evaluation method is very important method. So India will calculate its GDP on expenditure and GVA, product value added method. So please remember this. Please remember this method. And in this entire class, I forgot to mention some external factors, the government and taxes and subsidies, because I want to make this topic simple and clear. Okay, so we already know GDP at factor cost. If we include taxes and subsidies, we get GDP at market prices. It's a bit complicated. If I had a blackboard, I could have explained you in a proper way. Unfortunately, I didn't have it right now. So we had GDP at market prices, and the next factor is depreciation. Next topic is depreciation. Let's try to understand a depreciation with a simple example. So take the example of a Uber service, right? So the car Uber driver, suppose hypothetically speaking, he is earning 1 lakh rupees per an year. But after 1 year, he has to replace his tires. Why? Because they will wear and tear. In economy, we call this as depreciation. You may think he earned 1 lakh per year, but he need to reduce the price of the tires from his total earnings. In this case, hypothetically 20,000. So the cost of the tires are 20,000. If we deduct this 20,000 from the amount he earned, it will become 80,000. So we consider 80,000 as a gross value added in an economy to in an economy for his service. Okay, this is called depreciation. The summary of this topic is to produce any good or services, we need to use some intermediary goods, in this case capital goods. Okay, they will depreciate over the year. Whatever the fuels, lubricants, general wear and tear, we need to reduce the deduct this depreciation to get the exact value of GDP. That's it for GDP. And the next topic is national GNP, Gross National Product. Try to decode the acronym Gross Total National Product. What is its relevance to exam and what is its importance? See, we have most of the companies. India as a tech hub, we have a lot of companies has the offices abroad. In America, we have TCS, Infosys, Wipro, lot of IT companies. They are operating their operations in abroad. In UK, we have Tata Steel and Tata Enterprises. In Japan, we have a lot of software industries. So we cannot exclude these Indian companies from our GDP because they are contributing so much. They are adding so much value to our services. So we are including these companies and the income they are generated abroad the India with our final value of goods and services. We call this as gross national product. Here we must remember that the abroad foreign companies who are operating in India like Amazon, Google, Samsung, Apple, we need to deduct the value of goods and services produced by these countries from our GNP. It's a bit tricky, but try to understand. I will explain you in detail with a formula difference between GDP and GNP. For a simple note, I am telling you that GNP is equal to GDP plus net factor abroad income. Try to remember this. I will explain in detail. So this is GNP. Again, we need to depreciate. We need to exclude the depreciation from GNP, gross national product. If we exclude the depreciation, we get net national income. This is very important. We already know the factor income, right? Right? GNNP, net national income at factor price. We call it as national income. So we started where we have started. We are trying to understand the national income concept, right? To get national income, so national income, what is national income? Net net national product, net national product at factor price. So this is we in India we consider net national product at factor price as national income. So we divide the net national product at factor income by our total population, we'll get national income. Again, here in this topic also I excluded the subsidies and taxes. We need to include, or it will become bit complicated, but we need to include these external factors also. Then we'll get the clear picture of GDP and GNP and national income. Thank you for listening. Yes, there is scope for improvement. I will do it. Thank you for the opportunity. If you like the video and if you think this is informative, please support me and please help me.